Okay, let's dive right into this. If you ask people what the absolute best, single most important invention in the history of global businesses, they'd probably say the assembly line, right? Or maybe the internet. But it's actually neither. It is the elegant, perfectly balanced bedrock of all modern commerce, the double entry accounting system. In today's explainer, we're going to look under the hood of this incredible, world changing framework. We're going to trace the entire life of a single transaction, from the exact moment it occurs all the way to the final financial reports that global CEOs rely on. So, here is our roadmap for today. We'll start with the core philosophy, move into the procedural flow, then look at journals and ledgers, figure out finding and fixing errors, and finally wrap up with the final financial statements. Let's kick things off with Section 1, the core philosophy, the rules of the game. Now think of the double entry system like the ultimate scales of justice. It's a strict set of rules where every single time financial information is recorded on one side, which we call a debit, there absolutely must be a corresponding credit entry. In this system, absolute harmony is required. Literally every financial action has an equal and opposite financial reaction. Say a business buys a delivery van with cash. It gains an asset, sure, but it also loses cash. Balance is always perfectly maintained. Think of these core rules as the Rosetta Stone of accounting. It just beautifully structures how different elements are handled. So if you want to record an increase in assets or expenses, you debit them. But if you look at liabilities, capital, and revenue, they actually increase with credits. Now, I know it might seem like a secret language at first, but this simple matrix is exactly what ensures that a company's books always remain in perfect equilibrium. And all those rules, they lead us straight to this, the accounting equation. This is the ultimate formula. It definitively proves that the resources of a business, its assets, will always exactly equal the resources contributed by the owner, which is the capital, plus any outside liabilities. It's really the mathematical heartbeat of a business. Now, to keep everything organized, the system sorts accounts into categories. Personal accounts deal directly with people, like your debtors and creditors. But everything else, that's neatly categorized as an impersonal account. And these are divided up too. You've got real accounts, which record physical possessions and property like machinery or stock. And then you have nominal accounts, which track your expenses, income, and capital. It's brilliant because there's a place for everything and everything is in its place. Moving right along to Section 2, the procedural flow, the accounting cycle. So this six-step journey is exactly the path we're taking today. It starts with capturing source documents, moves right into journalizing, posting to ledgers, extracting a trial balance, making necessary adjustments, and finally, preparing those final financial statements. Breaking it down like this prevents cognitive overload by giving us an exact step-by-step path from a raw, real-world event to a polished report. Okay, Section 3, journals and ledgers, capturing the evidence. This is what we call the prime entry. It's the very first place where a transaction leaves its real-world footprint. Because before a transaction even enters a ledger, there must be physical, real-world evidence that it actually happened. These are your source documents. It could be a sales invoice sent to a debtor, a check written out for rent, or a receipt given for cash. They are the undeniable proof that a transaction took place. They act as the raw data for our double entry machine. And honestly, it's this standard of verifiable proof that first allowed global trade to scale with trust. Now, what happens when things don't exactly go as planned? Well, the double entry system handles this so elegantly. Take returns, for example. We have return inwards, which is when a customer returns faulty goods to the business, and this naturally gets deducted from sales. Contrast that with return outwards, which is when the business itself returns faulty stock to a supplier, deducting it from purchases. Two sides of the same coin, perfectly accounted for. Discounts are another really fascinating dynamic. Let's say you give a discount to a customer to encourage them to pay faster. That is a discount allowed, and it's actually treated as a business expense. But if a supplier gives your business a discount for paying your bills early, that is a discount received, and it is recorded as income. It's so cool how a simple reduction in price takes on completely different identities depending entirely on which side of the transaction you're sitting on. Which brings us to Section 4, finding and fixing errors. Time to play the accounting detective. Despite this being a literally perfect mathematical system, humans are, well, human. Mistakes happen. Welcome to the detective phase, where we hunt down imbalances. There's actually a fascinating taxonomy of mistakes here. An error of omission is when you just entirely forget to record a transaction. An error of principle is booking a brand new motor vehicle as a day-to-day expense rather than an asset. But the most interesting to me is the transposition error. This is simply swapping two digits, like a tired clerk writing down 1420 instead of 1240. And even a tiny, seemingly harmless mistake like that completely throws the whole system out of balance. To catch these snaky errors, accountants extract a trial balance. It is essentially the ultimate lie detector test. It lists all the debits on one side and all the credits on the other. If the totals at the bottom do not match exactly, then an elusive error is hiding somewhere in the books, and our accounting detective has to go back and hunt it down. But what happens if you have to close the books right now, today, and you still can't find the error? Well, you use a suspense account. Think of this as a temporary quarantine zone. It holds the discrepancy, the exact amount that the trial balance is off by, until our detective can solve the mystery and distribute the numbers back to their correct homes. To prevent errors from spiraling in the first place, massive businesses use control accounts. The sales ledger control account verifies the math for your entire list of customers, while the purchases ledger control account checks your massive list of suppliers. These act as a fantastic supervision tool. Instead of checking thousands of individual receipts manually, a manager can just look at the control account to instantly verify the arithmetic accuracy of the entire ledger. This elegant check and balance is exactly what allows modern, multi-billion-dollar corporations to scale up without collapsing under their own data. Another really crucial detective tool is the bank reconciliation. You see, a business's internal cash book almost never perfectly matches its monthly bank statement. Why? Usually it's just because of timing. You might have unpresented checks that the bank just hasn't processed yet, or unexpected bank charges you didn't even know about. Reconciling these two documents is a totally vital step to uncover the absolute truth of a company's cash position. Finally, we reach Section 5, Final Financial Statements, the ultimate output. This is where we calculate the raw profitability of a company's core operations. It's the trading account. It takes total sales and deducts the precise cost of those sales. So factoring in opening stock, what we purchased, the cost of transporting it inward, and then deducting the stock we still have left over. By tracing the pure movement of stock, this document reveals the raw, gross profit.
But before we lock in that profit, we have to respect the matching principle. This basically means revenues and expenses must perfectly align in the correct financial period. If we used electricity in December but haven't actually paid the bill yet, that's an accrual. We must record it as an expense right now. If we paid rent for next year in advance, that's a prepayment and we must defer it. It just ensures our profit isn't distorted by simply when cash happens to change hands.
And finally, we reach the statement of financial position, which you might know as the balance sheet. This brings our whole explainer full circle back to the accounting equation we learned at the very beginning. All the non-current and current assets are tallied up, and they must exactly match the sum of the owner's capital and all liabilities. When this balances, it proves unequivocally that the business is in perfect harmony. So, we've seen how a single, simple receipt triggers this incredible chain reaction of debits and credits, perfectly balanced, ending in statements that define a company's entire worth. So I want to leave you with this thought. If every single transaction, no matter how small, requires a perfectly balanced debit and credit, how does this invisible, meticulous architecture shape the massive billion-dollar economic decisions made by global businesses today? When you really think about it, it truly is the greatest system ever invented. Thank you for joining me on this explainer. Keep questioning, keep learning, and I'll see you next time.